And
Okay.
again, we've not behaving like a blow off top. We're just emerging from congestion. Our assumption is over the next, say, 5 months or so, next 2 quarters, you're going to see silver in the 60s to 70s in the surge, this surge. Now,
Yeah.
that's not the top. I'm not arguing that's a top. I'm arguing in this particular surge that is just beginning. I think you could see us well above the old 50 highs up into the 60, 70 zone before you even pause. I fully agree. But right now, I'm just looking at this leg that is beginning to unfold. And I think it's going to blow past that silly high at 50 and the other high back in 1980 at 50,
Yeah.
which is, they're sucker highs. They're ridiculous. In
Yeah.
real dollar terms, we'd have to be probably $200 or 300 just to match those highs.
Analyst Michael Oliver believes silver is not in a blow-off top, but instead just beginning a significant breakout. He expects silver to surge to $60 to $70 over the next 5 months, well above its historical highs of $50, before even pausing. He dismisses past peaks as artificial sucker highs, noting that in real, inflation-adjusted terms, silver should be closer to $200 to $300. While some experts even foresee a $200 silver price, Oliver is focused on the current leg of the rally, which he sees as just taking off. The US dollar index has been in a long-term downtrend, with lower highs and lower lows since the 1980s. Recently, it broke below key support levels, and if it closes any month below 98.35, the 10-year moving average, it could trigger a more profound decline, potentially into the 70s. While the dollar's value often impacts gold, the speaker notes that there is no consistent correlation. Gold has quadrupled in value since 2015, even as the dollar has remained relatively stable. However, a sharp drop in the dollar would still support gold prices by weakening global confidence in fiat currencies and potentially prompting foreign investors to exit dollar-denominated assets. Michael is heavily invested in silver and silver miners, including through the GDX ETF, which, despite its gold-focused name, also holds several major silver mining stocks. He believes that junior silver miners, smaller, less expensive stocks, will likely become popular later once mainstream investors seek lower-cost entry points into the sector. Historically, when major miners rise, they tend to acquire juniors, which in turn pushes their prices up. He also tracks the silver to GDX performance spread, which suggests silver miners are poised to outperform. Though they haven't broken out yet, momentum indicators show they're basing, and a breakout could be near. He's currently buying large silver miners in anticipation. Before diving in, don't forget to subscribe and hit the bell icon for timely updates.
First of all, we look at the dollar index as a separate, it's a major category. It's a big mover, okay, because it's also the euro and the yen. The other side of that is 70% of the dollar index.
Hmm.
Yeah, punch that guy up there. That's the dollar index. You can see it's been in a layered decline for decades.
Yeah.
Big drops, big rallies, big drop, big two waves down, two big waves down since 1983. And boom and a
Yeah.
boom. Okay. And lower highs and lower lows. So, okay. Now, even the price has nipped out the last few years' lows. If you can focus more on that there, just the last, yeah.
Last few
You can
years.
see we made lows, and after the high at 115, we collapsed down to 100 level in
Hmm.
23 and 24, and we kept getting buyers there.
Yeah.
100 level, rally, 100. It was really a non-event. In other words, you were in like a 7% range for a couple of years there. Across that, yeah.
Yeah.
They played a price game. They tried to break out upside late last year, early this year. We said it's a bull trap. Don't trust the breakout. Sure
Yeah.
enough, in March, which is in the middle of that range there, you'll find it 104 close in March,
Yeah.
which is that, go over to the
Oh,
right.
that's October.
No,
Sorry.
this March, 4 months ago.
Oh,
Right there, that
right.
month, we
There
got
we go.
bearish there. We said, okay, that's it, it's over. Dollar index is going down now. Major trend. Now, even price has followed through since then and broken through the price lows at 100. You had a rally back to 101 after reaching 98 a few months ago, went back to 101. Now you're back down. You even got into the, below 98 in
Yeah.
this month. Okay. But you're below that broken structure, groping. Now, there is another level at 98.35.
Yeah.
That's a 10-year moving average of the dollar index cash. It happens to be a momentum trend structure that goes back decades. When you plot an oscillator of the dollar index versus its 10-year average, you'll see there's like a multi-point uptrend that we will crack and close below if you close at 98.35 any month this year. We've traded below there. Right now, we're slightly above it. You do that, and our last floorboard comes out. And at that point, I would say the dollar is probably headed back down into the 70s. The question is, what does that impact gold? Well, right now, at the current price, If you get that 98 level, you go back over to the left in 2015, where you go there, that big surge.
Yeah.
We forecasted that bull trend would get bullish in 2012, and it got up to 100. We thought it would get to 100. It did, went ultimately higher. But in December of 2015, when gold bottomed, the dollar was where it is right now. Draw a line straight across. Effectively, you're nowhere. 10 years, it's gone nowhere. Okay. Yeah. Yet gold is quadrupled. Okay. So the people that think, well, the dollar has to impact gold. Well, sometimes not. It's the ongoing overall degradation in money units, not just the dollar. And its real value degradation could be different than the dollar index. The dollar index merely measures it versus other degrading currencies.
Yeah.
It doesn't measure the dollar versus its own money growth. Okay. But anyway, so net price to net price, I don't know that there's a great correlation. However, if you get a dynamic down move going in the dollar, that will no doubt help. It will be further wind at its back. It's not a pivotal thing. Again, gold is quadrupled, dollar's gone sideways. Okay. But I think a further drop here will exacerbate the situation, will also create wave effects in other markets when the dollar breaks. For example, foreign investors who own what? A lot of American stocks, more so than in history, foreign investors have come into our market. My own personal investments are in silver miners, and also GDX, which also contains about a half dozen major silver miners, by the way. It's not just gold miners. It says gold miners ETF, but there's some big silvers in there. Same with XAU index, has quite a few big silver miners in it. I suspect that the juniors, SALJ, for example, will suddenly get hot a bit later. And that's usually when the let's say, they're cheapies, okay? You can buy them for 50 cents, $1, $2, that kind of thing. It's when the average Joe investor who's not been in the gold miners thought it's a bad place to be, which in fact it has not been, despite its seeming irregularities in its price movement. It's actually been better than gold, as we've measured. They'll suddenly say, I want to get in there. And they're not going to want to buy a $100 stock or a 50 on a spread basis, a relative performance basis, like SIL versus GDX, silver miners versus GDX.
Okay.
And they haven't quite broken out. Silver miners basically went and took out that low in 2019-20 that it made there at the 0.91% level. Do you see that sharp drop in 2020?
Oh, yeah, right here.
Over there. You got below, but you got back above it. And in other words, you're basing. And momentum of this spread says, yes, you're basing. And it won't take much firmness this month or next to break this spread out on a momentum basis versus GDX, saying, now it's time to shift over to the silver miners. And I think that's likely to happen. I'm betting personally. I'm buying some of the major silver miners.
Whenever financial stress hits, whether in bonds, stocks, or the broader economy, central banks quickly respond by printing money, slashing interest rates, and injecting stimulus, which devalues the currency. Gold thrives in this environment because it rises as the value of money deteriorates. With the bond market, especially government bonds, and the stock market in fragile and inflated states, any significant decline will likely prompt the Fed to enter panic mode, easing. Historically, gold has outperformed during stock market bear trends for this very reason, and the speaker believes it will do so again, especially as the Fed faces mounting pressure before Powell's term ends. Michael Oliver believes a broad commodity boom is underway, not just in oil, but across the entire sector, as indicated by bullish momentum in the Bloomberg Commodity Index. Oil's recent drop below key support in April was a bear trap, and prices have since rebounded, with momentum now pointing toward a breakout if monthly closes stay above $70. For miners, oil remains a cost factor, albeit manageable compared to past highs. Gold miners are becoming increasingly attractive as they've begun to outperform the gold market, and investors are recognizing their improving margins. The speaker expects miners to significantly outperform gold and silver, surpassing both, especially as they break through long-term resistance levels, signaling a powerful new uptrend. Now, let's have a look back at the interview.
It's not that they're buyers so much as that they're going to be printers. We know that every time there's a hiccup and gut pain, they come in and they print, they expand the money supply, they lower interest rates beyond reality, and they create monetary stimulus and therefore further sharp degradation in the money unit you use to measure your assets. So the gold price will continue to move inversely to the degradation in the money units. And we see these other factors we've been talking about, like a bond market in jeopardy, government bonds in particular, not mortgages this time. And the stock market bubble, especially here, as being factors that will spark a central bank into panic mode. So gold knows that. Gold knows what central banks do, and that's why it lives. So if we have another downside in these other assets that your guest, your subscriber mentioned, that will further impact the central bank into doing exactly what benefits gold, namely degrade the money unit rapidly. So that's why if you go back and look at the 70s or look at these bear markets that occurred in the stock market, gold went up during those times. There's like a few exceptions of a month here and there where it went down with the stocks. But generally, it goes opposite to the stock market in bear trends. Why? Because the central bank is going berserk during that time. This time, even more so. We'll have to. So I think gold knows that. So I think the drop in those categories is bullish for gold. Up there. Now, you see back in 2008, we got the 140.50. Then in the 2022 run up, we got the 130. Okay.
Yeah.
Now, that peak was like a month after the war in Ukraine started. Okay. So it went up because of the Ukraine thing. No, it didn't. It was already up there.
Okay.
90% of the move had already occurred, and you topped shortly after that war commenced. Okay, in February, late February 2022. Then oil collapsed, just like the Bloomberg. It pulled back sharply, and you spent like a year or two sideways there with repeated lows in the mid 60s.
Yeah.
65, 65, 65, 65. You blew through it in April. That's a price chart breakout. Okay, remember that gold chart we looked at a while ago where I showed the breakout in 2022 where you blew through a floor?
Yeah.
We said that when this oil breaks through that floor, we said this is a bear trap. It's not likely to hold. It's false breakout because momentum wasn't agreeing with it.
Yeah.
And sure enough, we've aborted back up. Yes, it's news related and so forth. But you close out this month, but I'm particularly looking at next quarter, which is a couple weeks away. You close out any month next quarter. So in other words, let some of this news dissipate or get foggy. And you close a month out much above 70. We're well above there now.
Yeah.
You break quarterly momentum out. Now, you can't see it here. The price chart looks like you've got descending highs. And you're approaching that trend line across recent highs. So even price is now approaching a trend line, a downtrend going back to 23. But momentum is already breaking through stuff that says you're starting a whole new up leg. The Bloomberg Commodity Index in particular we're focused on because it's a broader view of reality than just the oil market. And I think it's about to go up. Now, there you go. In fact, it's at levels you can't close the month out above 106.50 something because if you do, you're breaking out annual momentum of Bloomberg. Got a basing process here for a couple of years.
Yeah.
Just nothing. It's a non-event.
Yeah.
And if you close over 106.50 and change, we're going to break annual momentum out and says, I'm going again. Another leg. It won't just be oil. Now, the question about the miners and oil. Yes, oil is a cost factor in mining production, but it's still low compared to highs we've seen over the last 5-10 years. And two, first off, this thing with Iran is not that big of a deal anyway. Iran only produces like 1 point something percent of the world oil supply. Okay, so it's not that big of a deal. It's not like Russia, or et cetera, or the U.S. production. So it is a cost factor, no doubt. But also, have the miners ever really priced in the per ounce profit they're making on gold? No, they're just waking up to that reality. An investment public, which is getting more shaky about the stock market, and asset managers who've got their heads screwed on right, are looking at places to be within the stock market that are not performing in an uncertain way. And I think gold miners have slapped them in the face recently because gold miners have suddenly grown a backbone, which we expected. Yes, I think miners are a better place to be than gold. I think they could double or triple the performance in gold over the next year or two. Which whatever gold does, triple that on a percent basis for miners. Yeah. There's technical reasons for that. And I think silver could outpace them both, big time, on a percentage basis. In fact, I think this move in silver right now, you paused here at 37, which of course has taken out a bunch of highs. Yeah, you can see the distribution highs up there at 35, 35, 35.
Yeah.
You don't ultimately top that way. You might pause there, but you don't top. You generally spike when you make a major high. You go back to the 2011 high. It was gaseous.
Right
You
here.
didn't, once you made that high, you collapsed. You never got back to the high again.
Yeah.
I mean, you collapsed the first few months off the high, came back, but you could never get back to the high.
Yeah.
And it was gaseous. It was hardly even a high. The reality up there above the mid 45 level or something, it was temporary. This time we've just come out of congestion, and you'll notice if you draw a line through the lows in 2011 and 12, where silver pulled back to about 25 there, going up, the lows that occurred, right there.
Oh, right. These ones right here?
Yeah, right there.
Okay.
Find the low close in there. Go up a little bit further. The low monthly close in that zone. You'll see a bar there. You go up a little bit further. Take that line up, your line up. The red line's there. Right up a little bit. Take it up. Yeah.
This one?
No, take it down some now. Right about the stop. Yeah. Move
Okay.
your solid line up a bit.
Low is 26.10.
No, the close. You'll notice the
The
month.
close is 27.
Yeah, and if you'll look over to the left, you'll see another close at about 27 something.
27.75.
Yeah, I know. Or even back and further, there's a bunch of closes there. Now, if you go horizontally, look at the recent action. Look where that line intersects. We stopped basically at that upper 20s repeatedly there in the 2021, et cetera. Finally broke through it. So you broke through a price level even that said, hey, man, wake up. You just went through a major pivotal zone.
Michael Oliver presents a compelling case for a powerful surge in silver and broader commodities, driven by structural currency weakness, central bank intervention, and investor rotation into hard assets. He argues that this is not a blow-off top, but rather the early stage of a generational move, especially for silver, with $60 to $70 as a near-term target and much higher prices possible in the long term. As fiat currencies weaken, miners, particularly those in the silver sector and junior companies, are poised to lead the charge, potentially delivering outsized gains as the commodity cycle accelerates. For investors watching inflation, monetary policy, and market fragility, the next phase could be both volatile and rewarding. Do you think silver can realistically break past its all-time highs and hold above $50 this time? Are you currently invested in precious metals or considering silver miners as part of your portfolio? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.